Good afternoon. It is Wednesday, the 11th of November, 2009, and the market's closed. We had the S&P break out to new highs for the move, and since this March bottom, and pretty much for more than a year or so, we have new highs. We're obviously still below this trend line and below that 50% retracement of the 2007 high to the 2000. I'm sorry, 2007 high to 2009 low. But the thing I was pointing out earlier in the day is that a lot of times when we have these rallies like this, and then a breakout type of thing, that these moves a lot of times do end up failing. So we have to be careful about that. The evidence isn't here yet. We closed right at the daily VWAP, so even for today, the buyers did manage to maintain control. We were below the daily VWAP for most of the day, but you can see we closed right on it. If you look at the average price of the last 2 days, we kept finding some support, in that general area today, and getting back above 115.25 or so tomorrow, then we could continue to add to this rally. But even when you look back 5 days at the volume weighted average price, it's way down here at 108.30, and obviously we're in an uptrend, so there's no sign that the buyers are taking, or rather the sellers are taking control. We have a little bit of support here at 109.65 ish, and if that breaks, then perhaps we're going to see a move down towards the 109 level from yesterday's lows. But again, the pattern of higher highs and higher lows is still existent in all but really the 1 minute time frame where it's more neutral. So we remain in an uptrend. It's easy to look at this and say it's up too much, or whatever the headlines are that might scare people for the moment of the day, whether it's unemployment numbers, or an earnings report, or just some broader economic development, weak dollar and that sort of thing. We still have to just follow price action because it obviously remains higher. We're up 56 cents today, another 0.5% added, and anyone that's fighting this is really getting their teeth kicked in. The Nasdaq, for its part, was also up and closed at a new high for the move. The volume. Let's go back to the S&P for a moment. Volume remains lower than the 20-day average, but average basically of the last week, and that's another thing that people are complaining about. But it's on light volume. But again, that doesn't matter. The volume doesn't pay you; only the price does. The Nasdaq, we have the same thing here, and that is that we've got. A lower volume move, but again, another new closing high here on the weekly time frame. We've been looking at this level as a potential area for resistance. We're still kind of in that little range, and right now there's just no evidence yet. If this market, for it to really break, is, I think, going to have to take some kind of big unexpected surprise. But every dip so far has been bought. We still have these higher highs and higher lows, and right now we've got what should be a strong level of support down near 40, or about 10% away. And a 10% pullback after the magnitude of this rally that we've seen really wouldn't be much of a pullback at all. It would hurt, obviously, if you were, long at the highs basically, but just prudent money management and looking at the definition of trend, higher highs and higher lows, we can see we've got this higher low at 43.40, then here at about 43.60, and we have these higher highs too. If this is a lower high, then we have to break below here to add a lower low to it. But again, there's zero evidence that we are breaking down. The Nasdaq, pretty much the same exact pattern as the S&P today, and getting back above 43.90, 43.95 maybe, then we could see another surge higher as this market just continues to defy the skeptics and climbs a massive wall of worry. The Russell has been the weakest group, as we know. It's still having trouble with that declining 20 and 50-day moving average in here. It was bigger volume on the way down, followed by low volume on this rally, so that leaves it clearly vulnerable. And if we look at the Fibonacci in here off of the highs from about that 62.5 level to the recent lows, we came right up and touched that 61.8% retracement. So let's take a look at that actually on the 30-minute time frame. We can see here, here's the two-thirds retracement level, and we touched exactly on it basically today before selling off. Now that's not a reason to sell short. It's a reason to look and say, well, we have a couple things here. We have this two-thirds retracement. We have this prior support, and we have this prior support just above at 60 and a half as well. That's a bigger level. So maybe we're going to continue to make a higher high up towards that level, continue to stair step, but that does give us the two-thirds retracement does give us reason to look at this market and say, here's where, if it's going to fail, this is a likely area because it's a two-thirds retracement, because it's the location of the declining 20 and 50-day moving average, and because we have lighter volume on this rally in here. So that leaves it vulnerable to a pullback, but we need to anticipate all potential scenarios and then wait for price confirmation before we actually participate. So there's no reason to participate on the downside right now. Breaking below 58.80 or so, maybe we get a little bit more defensive. That would basically bring us to the 5-day moving average, as the 5-day moving average is advancing, and it would probably take another couple days of sideways activity before we really could break lower. But we have to be aware that, breaking that 58 level and holding below it, 58.80 rather, and holding below it, then puts us up for a test of 58.30 and 58.30. If we come down, bounce from there up to a declining 5-day moving average or flat 5-day moving average, that could be setting up the next bigger sell-off on the daily time frame, that maybe brings us down even to the 200-day moving average, which is about 51.80, $52 a share, let's just call it. But still, that would be quite a healthy correction, but still leave the weekly time frame in decent shape, as it would be above the rising 200-day moving average. So really still mixed picture in here, except it's not really, it's mixed across the different time frames. The short-term time frame is pretty clear, though. It's higher highs and higher lows in this Russell 2000. The semiconductors really have recovered very nicely. They're back up to the high end of the prior range before the Intel breakout, and this had been really the main range, 24 to about $26, 26.20, and we're right up to the top end of that range. We were looking at this declining 20 and 50-day moving averages potential resistance. It didn't find the resistance there, obviously. We did close slightly below the daily VWAP in here today, but looking at the 30-minute time frame, still a very clear uptrend here. A 5-year-old could draw in the fact that we're making higher highs and higher lows here. So what is the most important near-term higher low? This 25.65. It was resistance here, support today, breaking back below that. Then we probably will head down towards a test of the 5-day moving average at about 25 and a quarter. But that doesn't make it negative on the daily time frame. It's more neutral again. Financials were up 20 cents today, and as I had said midday, we're getting back to that prior level that had been important at $15.10. The 15.10 level was important for a while. We had actually tested it today. Actually, today's highs were right at about 15.13. So we're at in these financials, we're at an area where this prior support is likely to, often will act as resistance. If we take a look at the Fibonacci from this high to this low, we're right beyond that two-thirds retracement, kind of pierced through it intraday and then backed off a little bit. The sellers really didn't gain control, though. More, the same of what we've seen in all the other markets, which is strong early, sold off, and then kind of chopped around throughout the day. So on the 1-minute time frame, we're below the daily VWAP. We touched the 2-day VWAP perfectly in here this afternoon. That's where it did find a little bit of support. So we have to look at this thing realistically, one day at a time. We have this 14.85, breaking 14.85, then we probably see $14.60 again. That's where we're likely to meet the 5-day moving average as well. I don't think that breaking 14.85, some people will call the top of the financials. I don't think it's prudent to call the top while we still have a rising 5-day moving average. I'm talking about a top of an intermediate term move. It may well prove to be that, But if you're going to get short, you short on a 1 minute time frame, and you manage your risk on a 1 minute time frame until the 2 minute time frame tells you that you should be short and hold as well. Then you manage on a 5 minute time frame and a 10 minute, and maybe you can pick a top that way. But it's very unlikely in most cases to pick a top. And look at these the commercial real estate. This market looked like it was on the verge of death just last week and early this week. In fact, it survived that test of that 39.50 level, and like we see a lot of times from that failed breakdown comes this fast move higher. So the IYR continues to frustrate short sellers. We've got the 10-minute time frame here and a very clear pattern of higher highs and higher lows. 42.60 is the near-term level of importance for this market. Breaking that, then we probably test the 5-day moving average in here as well. So the 5-day moving average is, we break today's lows basically. It looks like we're probably headed for a test of the 5-day moving averages in these markets. And for scalpers, there'll be good short trades in there. And you either want to do it by do you want to short the IYR or do you want to go long the SRS? The SRS has been a horrible instrument for anyone who's purchased it and is still holding to this day because we're at an all-time low on a closing basis. Once again, in the SRS, this is a triple short exposure, but there can be some nice trades in it, but generally not below a declining 5-day moving average. If you're interested in shorting the the Russell 2000, do you do it by directly shorting the Russell, or do you go long the 2 times short fund, the TWM, or maybe the 3 times short fund with the TZA? You can see they look the same, but the percentages are going to be different. So those are ways to consider gaining short exposure. And again, basically just for day trades. I think right now until we have evidence that we're rolling over, because basically we don't have that evidence right now. Safeway continues to hold up. We have our stop there at 29. Well, I'm not sure where we have it, but we didn't get hit. So let's raise the stop up to 23.10 right now. I think we had it at 29.90. Let's raise it below the low of the last couple days, $23.10. That will give us a 40-cent gain, and it's grinding higher. It's acting good in here, and maybe breaking the 23.40, we'll get another push higher in that. BCRX has been a good one. We got involved yesterday at $11 a share. I had suggested selling half at about 11.60, and we have the stop right now on the balance of this position at 12.05. That's pretty tight, but I was looking at, we had it earlier at 11.90. It's making this real nice pattern of higher lows on the 5-minute time frame. So that's why I'm suggesting 12.05 right there. It matches the definition of the uptrend here on the 5-minute time frame, and likely to get stopped out. So if you're thinking that it's a better longer term hold, then adjust your stop accordingly. But we have it at 12.05. That will give us a $1.05 gain. We did get stopped out of that FINL. Like I said, I counted it as an official play, but I think that most people probably didn't and shouldn't have gotten involved. If you did, we were stopped out for a dime. That's it for now.